Markets kicking off September with a slow start. Still, the S&P is up 20% so far this year. Our next guest says he expects a 10% correction at the end of what he calls the mid-cycle transition. Joining us now to explain, Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist from Morgan Stanley. And we had a long discussion last time you were on, Mike. I guess it was like a month ago or so. And you had raised your target on the S&P to a level that was still well below where it was trading at the time. And we haven't made very much upward progress on the S&P since then. And I'm just wondering if you update us, is your scenario playing out in your mind? Are you seeing some weakening indicators that make you think you're going to be right about this?
Yeah, we do. And look, I mean, the mid-cycle transition, Joe, is as much about, picking the right stocks and being in the right parts of the market as it is about, figuring out what's going on in the S&P 500. And in that regard, the mid-cycle transition has played out perfectly, right? There's been a massive rotation away from low quality to high quality stocks. Early cycle recovery stocks have underperformed. Obviously, small caps have really lagged. And so that's played out nicely. And so, yes, we're right on schedule for the finishing move, which is typically they eventually get to the quality stocks because that's, they're the ones that are now expensive. And as far as the fundamental evidence goes, since we spoke last, absolutely. I mean, we've seen consumer confidence confirmed, UMich and Conference Board suggesting the consumer is fading a bit. Not a recession, but the consumer's tired. And that's been our thesis all along, is there's going to be a payback here on demand. Overnight, our economics team actually lowered their GDP forecast from 6.5% to 2.9% for the third quarter. They've kept their fourth quarter number the same, but look, there's risk to that probably if Delta doesn't fade, or my view is that Delta is a bit of a trap. People are saying, oh, the slowdown's due to Delta. The slowdown is not due to Delta exclusively, okay? What it's due to is the fact that we overshot on the upside. We had a monster stimulus, and now we're going to have some payback, and that's okay. But that's normal in the mid-cycle transition. That's what always happens. The difference this time, Joe, is that the amplitude of the cycle is just much greater, meaning, the upside last year was bigger, and now the downside and the slowdown part is going to be bigger too. And that's our view, and we're sticking with it.
And the 10% correction, you don't even necessarily think that we end the year down 10% from here. Your base case is 42.25. Okay, so that's not you figure we could have a 10% correction down to around 4,000 or so, or 4,100, and then close above that, and then your bear case is 3,800. That would be a year end. That would be a 10% correction from here if we close there for the year.
Yeah, well, look, let's clarify a few things. First, the 4,000 base case is for year end. The 42.25 is for March or May of next year. Okay, so that was our 12-month forecast at that time. And look, I mean, this is not that. I mean, let's not pretend that we're that precise. Okay, exactly. Let's talk about what we can try to figure out here, which is, look, the market's a little bit expensive. Obviously, everybody knows that. And we know why. There's a lot of liquidity. And look, we've been in an accelerative case for earnings and for growth. But that's now turning the other direction, right? The Fed's going to be tapering at some point later this year. And you're going to have a deceleration in growth and probably negative earnings revision breadth is our view. So that combination should get you at least a 10% pullback between now and year end, maybe into early part of next year. It probably overshoots that, quite frankly. And maybe we end the year at 4,000. Who knows exactly? The point here is the risk reward is not particularly great at the index level. That's where everybody's kind of crammed into the quality stocks. That was our call back in March. And now we're going to see, probably the quality stocks get hit, and maybe some of the stocks that have already been kind of, hammered are going to be okay. So consumer service is a good example. That's an area where we haven't overconsumed. Okay. Some of the, maybe some of the reopening stocks, people go back to those areas. And then we think these defensive areas will do better as people get nervous about the growth deceleration.